I think we've got enough on now to start. So good afternoon, everyone, and welcome to take 2 of this webinar. I'm Paul Johnston, for those that don't know me, and I chair the ACE Regional Committee here in Northern Ireland. I'm pleased to say that we resolved the technical issues that caused the webinar to be postponed last Thursday. This webinar today is about the hardening of the PI market, professional indemnity insurance market. And today we have industry experts from Griffiths Armour, Graeme Tinney and Stephen Hargreaves, both directors with that organisation. As I can imagine, everyone joining is aware that further hardening of the market has left many firms facing increased premiums, restrictions in policy cover, and in some cases an inability to source appropriate and effective insurance protection. At the end of today's session, we'll have a Q&A portion of the webinar, and I'll explain how you can send your questions through in the next slide. Repeat listeners to AC webinars will know all about this, but good to remind everyone. This is best experienced through headphones, which will help to cut out the background noise. To ask questions, please go to the Q&A button at the bottom of your screen, and we'll try and answer as many as possible. But don't worry, we'll also answer any others that we haven't had time to answer after the webinar. Don't worry if you miss anything. We will be publishing a recording to members of ACE on our website in the next few days. So if you want to listen again to us, you can. First of all, I'd like to welcome our first speaker, Graeme Tinney. Once Graeme and Stephen have finished, we will move into the Q&A session. Over to you, Graeme.
Thanks, Paul, and thanks, Chetna, in the background as well for all the work in putting today's webinar together and for the invitation to join you. I think, as Paul has said, most people on the call will be familiar with the problems that exist in the professional indemnity market at the moment. It's certainly no exaggeration to say that daily we're being approached by firms who either can't access cover or can't access the levels of cover that they've held historically. I've no doubt that at the moment there are contractors, there are consultants who are potentially having to operate without cover, and that creates difficulties for everybody. Just moving on to the agenda for today, I suppose what I'm going to try and do is put all of that into some context. So look at why those challenges exist in the first instance, what we're likely to see in 2021, and then getting into some of the simple things, some of the very basic things that people should be thinking about in the lead up to their 2021 renewal. Then Stephen's going to pick it up and look at things from a claims perspective, just maybe speaking about what we're seeing at the moment, identifying whether there are any trends out there, are there any new and emerging risks, etc. So getting us started, one of the things I wanted to look at was the insurance market cycle. And this is an image that I use quite regularly, I suppose, to illustrate the market cycle. And what it's important to remember, I suppose, about the insurance market is it's not static, it is cyclical, and it's largely driven by the availability of capital. So in order to underwrite a certain amount of premium and a certain amount of risk, insurers need to have a certain amount of capital in reserve. And when the market's well capitalized, well, then insurers write more business at less premium, the policy cover tends to be broader. But ultimately what happens is the wheel turns, the loss ratios move out, insurers begin to lose money, the return on investment isn't as significant as it was, they begin to make losses, and as a result of that, capital withdraws for a better return elsewhere. And that gets us to the point where we essentially have a reduction in the supply of insurance. And in that sense, I suppose the market is pretty predictable in terms of the pattern that it follows. And if we look to the next slide, we'll see that that was something that we were talking about back in 2018. So the last time that Stephen and I came to visit you in Belfast, we were providing a bit of an update on the market and where it was at that stage. And it felt, I suppose at that stage, like we were at a bit of a turning point. Lloyd's had just come out with a report where that identified professional indemnity insurance, non-US PI insurance, as their second worst performing class of business. And they put that down to a number of factors, but they were talking about behaviors in the market having been driven by an abundance of capital or an oversupply of capital, if you like. So too much money washing around the system, meaning that insurers were retaining more risks than maybe they should have. The pricing wasn't reflective of those risks, essentially underpricing the risk to some degree, not evaluating the exposures properly, providing broad coverage and not appreciating the risks that came with that, not balancing their lines properly on individual risks, and then delegated authority, where some insurers were actually handing over their pen to other parties to go and underwrite business on their behalf. And that was one of the things that we picked up on, I suppose, at that point back in 2018, saying that there had been this massive explosion in activity in what we call the MGA market. And we felt that that might be short term. And we felt that there may be issues over the next few years in relation to that, and whether or not those markets might be most severely impacted as the capital begins to withdraw. The other thing we were talking about, I suppose, is a bit of a perennial issue in some ways, where it's a challenging liability landscape that you operate in. So we often refer to this idea of risk dumping, where you're operating in a sector where people are looking to force risk down the supply chain through very onerous contracts and high insurance requirements. And in a way that leaves construction PI as being less attractive to insurers as a potential area of business. The thing we were beginning to see back in 2018, and Stephen will probably go on to talk about a little bit further, is the quantum of claims as well. So not necessarily the numbers of claims coming in, but the claims getting more expensive. And at that point as well, I suppose, had seen Grenfell the previous year, and we were beginning to maybe understand some of the issues around fire safety and the potential impact that that was likely to have going forward. And again, we can talk further about how that's played out over the last couple of years. The overriding message, I suppose, that we were trying to get across back in 2018 was that it was a time to make good choices. So when it came to the renewal of professional indemnity insurance, we were saying that it's important to be very careful, I suppose, in terms of not just the specification of cover, but also the insurers that you're working with, if we were going to be able to navigate through the storm that was beginning at that particular point. So looking on, the obvious question is where are we now? And if we just pop on to the next slide, well, I think this kind of summarizes where we are. I talked about the ebb and flow of capital within the market and how that drives the market cycle. I don't think we're talking about the normal ebb and flow of capital at the moment. I think what we're talking about over the last 12 to 18 months is probably an exodus of capital from the market. At this point, I suppose, to sum it up, there just simply isn't enough supply within the market to meet the demand that's out there for professional indemnity, whether that's the number of firms that are looking for professional indemnity cover or the amount of cover that they're looking to purchase. And in a meeting that I was at recently, actually, with a firm that wasn't a client of Griffiths Armour's, but they were sharing with me their experience of having gone through renewal. And I think they summed it up perfectly when they said they felt they were looking to purchase a product that nobody wanted to sell. So what we're seeing at the moment is issues, as I've said, on the availability of PI insurance. So people struggling to get cover or struggling to get the same amount of cover or the same specification, seeing significant increases in premium, really, really significant in some of the cases that are being reported back to us. Reduced limits of indemnity, so insurers that maybe previously were providing 5 million cover, now only prepared to provide, let's say, 2 million, and therefore there's a need for somebody to put an excess layer cover in place to fill the gap. In certain areas, particularly in relation to architects, people are talking about a possible move to aggregate cover across the board. So we've become used to the idea of an each and every claim limit, where you have a limit of indemnity for each claim that arises. What they're saying now is that it could potentially move to a point where you just simply have aggregate cover, one limit to deal with all claims in a year. There are areas where cover is being restricted. I think people need to be very careful about that in terms of the policies that they're seeing this year, and higher excess is being imposed. So the amount that you're required to contribute in the event of a claim arising, definitely moving back to that kind of 1.5% of overall fee income, and maybe beyond that in certain cases. Insurers are also avoiding or reducing cover for particular exposures. Fire safety, again, very significant concern for insurers, and go on to talk about that a little bit further. And I suppose then the question is, well, what are we likely to see in 2021? We all know what 2020 has looked like. And if we just pop on to the next slide, I think it's natural that when we look at the cost of professional indemnity insurance in the current year and we look at our renewal, what we'll tend to do is, well, where was it last year? You know, that's an obvious comparison to make. But insurers are looking at it a little bit differently. And when you talk to insurers, they're talking about the long-term picture, and they're talking about what they see as ultimately a downward trajectory in rates over the last 30 years or so. And what they're saying is that even though we've seen very significant increases over the past couple of years, they would still argue that they're not back at a level where things are sustainable, that the market has been a continual slide. And what they're doing now is they're taking corrective action, and they will continue with that corrective action through 2021. I think, though, if we look at this kind of historical context and the deviation that we've seen in average rate, and it's just a rough indication of how things have gone, what we'll see is that after any particular spike, there is generally a significant fall off in rate in the years that follow. So there's probably, I suppose, a different school of thought that might say, well, what we're seeing now is in line with the traditional market cycle, and at some point in the next few years, the market will move down again because the market will have corrected itself. Pricing will be at a level that insurers will be attracted back in. But we really just have to see, I suppose, how that plays out over the next few years. Looking on to the next slide, I think just to give a broader perspective on where the market is, and not just a Griffiths Armour perspective, back in June of this year, BIBA, the British Insurance Brokers Association, undertook a survey of their members. They went out to brokers, and I think they've said that the survey itself probably covered about 16,000 professional indemnity insurance policies, given the number of brokers that they were speaking to. And the feedback that they were getting to the questions that they raised in relation to what people felt the position would be in 2021 is that 90% of brokers were feeling that there would be increased premiums. 52% were expecting an increase in the level of excess, that amount that you contribute yourselves in the event of a claim arising. 75% were predicting a reduction in capacity, so a further reduction in the supply of insurance. And 65% were talking about additional fire safety restrictions in particular, but restrictions in other areas as well. And then 35%, so 35% of brokers that were spoken to felt that they would struggle to find cover for their clients in 2021. And interestingly then also in the insurance press, just that image on the right-hand side is taken from an Insurance Times article on the 8th of October 2020. And perhaps not surprisingly, they're talking about the MGA markets, those kind of maybe shorter term solutions in some cases that had been so prevalent over the last few years. And when we were speaking back in 2018, what they're talking about is the particular impact that the drain of capital is having in that area of the market, and the likely impact that that's going to have on supply in 2021. So again, something we flagged up before, but I think we just need to keep our eye on it heading into next year. So looking ahead to 2021, what does all of that mean? I think likely market conditions, it's safe to say, as I say, it may be that we're seeing the normal cycle, but nothing is going to start moving back, I don't believe, in 2021. I think the capacity problems are going to continue. I think we're still going to struggle with the supply side of things. I think more firms will struggle to source cover as well, just as came out in that survey that BIBA ran. I think particularly so if we're talking about firms with claims, and if those claims are disproportionate to the size of the firm, or they suggest that there are any underlying issues in systems, procedures, etc. And I think further restrictions will be applied, particularly in that area of fire safety. Areas on insurers' radar, I began to put together a list of areas that I felt insurers would be particularly focused on. And I can see Stephen smiling in the background there, because it is a very broad church. But unfortunately, that's the case. If you were involved in any of these areas, and we could probably spend the afternoon talking about any one of them, then the likelihood is that it is going to hit insurers' radar, and they are going to be asking more questions about it. So it's important that you have a good story to tell about your involvement in those. Again, fire safety is appearing top of the list. Partly that's about Grenfell, but I think it's about broader issues around fire safety. And one of the things that I suppose Grenfell has done is it's shone a light on the catastrophic nature of the exposure that's associated with fire safety. And really insurers now at this point are looking to protect their position. They probably don't fully understand all of the risks that are there, or maybe some of the questions that they should be asking. And I suppose in light of that, what they're doing is looking to protect their overall portfolio position, and they are introducing restrictions and exclusions around things like, for example, the completion of the EWS1 form. But I'd say we can maybe go on and talk about that in the Q&A session. So looking at the next slide and building towards renewal. I suppose my advice on that would be to adopt a strategic approach. I think you need to start the process early. And by early, I mean at least 2 to 3 months out from renewal. There's been certain renewals in the past year that we've started 6 months out because we knew that it was going to present particular challenges around types of work or claims, etc. So we needed to engage with insurers really, really early. Consider what you want from a broker. So if you're involving a couple of brokers, then what's that about? Is that about market relationships, that the broker that you're bringing in has different relationships, that they're able to provide a better specification of cover, that they have a track record in your sector or experience of your particular type of risk? The days of just simply throwing your proposal form out to 3 or 4 brokers are finished, you know, and actually it's counterproductive. We're operating now in a really small market, and the last thing an insurer wants is to see the same submission coming from 2 or 3 different brokers, and maybe the information is a little bit different. So you have to adopt a strategic approach. And if there are going to be a couple of brokers out there, what you might decide is which brokers are working with which markets, etc. And that's something, again, they're happy to talk to you about at any stage. I think it's important to set objectives at the outset. So what are you looking for from the renewal? Is it, you know, about getting a robust PI specification? Is it about working with the right insurers, or is it about cost? And if it's about making sure that your proposition is as robust as possible, then stick to that and don't be sidetracked, if you like, by an offer that comes in at the last minute that looks too good to be true and probably is too good to be true. Try and establish a timeline. It is really difficult in the current market for a broker. You know, sometimes you just don't have any option but to come back very late in the day, because it can be difficult to get time with underwriters. You can be faced with a whole series of questions that you need to respond to. But you should try and establish a timeline as to when it is terms are to be provided, or at least when updates are to be received by the brokers as regards how the discussions are going. I think be prepared. Sorry, Chetna, just the next point there is be prepared for greater information requirements. So insurers are going to have lots of questions. Be prepared to answer them. There will be questions around risk profile. So take time to complete the forms properly, to gather the information, to get the figures right. Again, it's really frustrating to receive a proposal form where, you know, the figures are wrong or some of the detail is wrong. And certainly that's not what insurers want to see. Don't deliver the information piecemeal, bits and pieces of information around claims. Make sure that the information you're presenting is clear, it's concise, and it's complete. And get a confirmed claims experience from your broker or from your insurer. And that should be available to them. They should be able to provide you with a summary of any circumstances that you've notified to existing insurers, and then maybe detail on the individual matters and how they're progressing. All of that information is what any insurer is going to be looking for. And find out if there's any reserves sitting on those claims as well. And if you feel that you've learned lessons from claims, if you feel that you've changed your systems and procedures as a result, then that's something that insurers are going to want to hear about. And the final point on that slide is just understand your duty to insurers. So sorry, Chetna, just, yeah, understand your duty to insurers. So, you do have a duty of fair presentation of the risk to insurers. Just make sure that you're meeting that obligation in the detail that you're providing to them. So again, building towards renewal, what sets you apart? So, proposal forms, ask the question, what does it really say about your business, about your people, your clients, your projects? I'd venture it doesn't say very much, actually. I think it doesn't tell the insurer who you are, how you're managing your risk. So it's really important that I think any proposal form that's being issued to an insurer in the current year comes along with a brief overview of your practice and provides a detailed presentation of your risk. So your approach to managing your risk And particularly, I think your approach on contractual risk management. So what are the deal breakers? When did you last walk away from a contract because you didn't like the terms that were there? What limitations do you look for within your contracts? Is there always a contract in place before you commence your services, etc.? All of that kind of information is what insurers will be interested in. One of the things they're not particularly interested in is the risk that you don't have. So I think sometimes people fall foul of trying to present to insurers that they've no risk, to turn around and say, well, actually, we don't have that risk because somebody else signs off on what we do, whatever. Well, you'd have to ask the question then why your client is asking you to have 5 or 10 million PI cover. You do have a risk, and actually demonstrating to insurers that you understand what that risk is, you acknowledge it, and you're managing it effectively is actually much more effective in terms of the discussion with the insurer than just pointing out the risks that you don't have. And just your submission to insurers is not a marketing brochure. And what I mean by that is it's been interesting over the last year where you're asking people to provide an outline of their business for insurers and to give insurers a better insight into what their business is about. And sometimes I think they fall into the trap of producing a report with, that's about really what they're capable of as a business. And it might have lovely images of high-rise developments and offshore wind farms and embankment failures, etc. And it might look great to a prospective client as a marketing brochure, but to an insurer, it screams potential risk. Stick to what you're actually doing. What is the work that you're involved in? Give the insurer a good insight into the type of business that you are, the type of clients you're working with, the type of projects that you're involved in. Just on the next slide, be nice. I think it's really important to understand, it's a difficult time. It is a really difficult time for firms when they can't access professional indemnity insurance or when the cost of that insurance is increasing dramatically. And we understand that fully, I can assure you, but it is not going to help your cause to adopt a hostile approach with insurers or to share conspiracy theories about the insurance market. Work with insurers positively if you're going to try and achieve the right outcome. And particularly around claims as well, I would say when claims arise, don't see it as insurers' problem. See it as an opportunity to engage with insurers, to work with them around the defense of the claim, showing how you're defending your position and insurer's position. I think similarly on renewal, again, engage positively, work with the broker and with the insurer. It is the way that you're going to achieve the right outcome. If you do end up changing insurers, be very careful. If there is somebody out there that's swimming against the tide, if the market's moving in one direction, but they seem to have continued appetite and charging low levels of premium, then as a broker, we would look at that. We would be very cautious and we would try and understand why that's happening. On particular aspects of cover, make sure the cover is retroactive if you're moving insurers. So in other words, it's going to cover you in respect of all the work that you've done up until that point. So if a claim comes in 2 weeks or 2 months down the line, and it relates to work that you've done historically, that the policy is going to respond. Similarly, if you're moving insurers, have you disclosed everything? Have you disclosed all the detail to the incoming insurer, but also have you let the insurer, your previous insurer, under the expiring arrangements, have you let them know of any potential circumstances that might give rise to a claim? And Stephen, I think, is going to talk later about late notification and the perils of that. Understand the changes in cover. Every policy wording is different. There will be differences between insurers, so understand the impact of that. And when it comes to the insurer themselves, it gets back to what we were saying in 2018. Make good choices, understand who the insurer is, what their track record is, etc. And put PI insurance at the center of your decision making. I think this is a really important point, actually, that the next opportunity that comes your way, the next contract that you're asked to sign, the next PI requirement that you're asked to sign up to, just ask yourself the question, how is that going to sit when I come round to renew my PI insurance? How is that going to be regarded by the insurer? And if we move on to the next slide, I think the point to leave you on, from my point of view, is that for many firms, your PI insurance renewal is going to be the most important negotiation you undertake in 2021. In terms of your negotiations with individual clients, if it goes bad, then the worst thing that might happen is you lose a project or you lose a client. If your PI insurance renewal doesn't go well, and if you can't access insurance, you could lose everything that you've worked for. Thanks very much.
Thank you, Graeme. So now it's my turn to to take over and just present a few slides on some observations from a claims perspective. And this really is just skimming the surface of a huge subject, as you can imagine, but picking up on some of the themes that Graeme has already covered. So any analysis of claims in any class of insurance involves thinking about both the frequency of claims being reported to insurers, how often is it happening, and then the severity. What do those claims cost? Which in this particular class of business will run from just a few £100s to several million, which makes it prone to skews in the figures. Frequency, volumes of notifications is perhaps pretty flat, actually, in my experience over the last few years. So it isn't just a case of there being more claims around than there were previously. You do hear people saying that, but it isn't necessarily literally true. And even if it were, it wouldn't necessarily be of significance in itself. So severity is much more significant, obviously, but it's also harder to measure accurately in long tail business, which is what construction PI is, until many years after claims have been reported. You've got to remember that a typical construction claim is a multi-party dispute. It involves knotty points of contention around fault. Did each party satisfy their duty of care or didn't they? Causation, quantification of loss, legal arguments around things like limitation periods, the interpretation or the enforceability of various contractual terms and so forth. And those things make for protracted disputes which can take years to resolve. And only once they have resolved are we able to say what they actually cost us, as opposed to what we thought they might have cost us. So that's one of the things that makes it difficult to quantify severity until it's almost too late, if you like. What we can say, however, is that overall insurers' claims spend is on the increase. It doesn't follow a nice, neat trend as such. Some years are less catastrophically bad than others, but there's no sort of consistent pattern showing a direction of travel, desirable though that would be for all others. And part of the reason for that is, as I say, the overall cost of individual years being skewed by the higher value catastrophe losses, which I'm putting at a slightly arbitrary level of insurers spending £1 million or more. So as an illustration of that, I can share with you that, if you took a snapshot, as I did recently, between October 2010 and then November 2018, in 2010, we had 9 claims on our books that were reserved at £1 million or above. And if you added up the total reserves for all of those, for the top 20, we had 29 million pounds in reserve for the top 20 claims. Skip forward 8 years, and your 9 claims at £1 million or above had increased to 15. It's only 6 claims, which doesn't sound like very much, but it's enough to make a huge difference. And your total reserves for your top 20 were up from 29 million to 49 million. So purely by coincidence, based on open claims alone, you had a 2/3 increase in both frequency and severity of catastrophe losses over a period of 8 years, which is pretty significant. It's not just the catastrophe losses that make the difference. They tend to be the things that grab the headlines and they provide the anecdotes that people typically find most interesting. But if you dig a little bit deeper, you'll find that what I'm calling here attritional losses have also deteriorated. So since 2013, we've seen a 50% rise in the frequency of claims paid or reserved within that category between 100k and £1 million. And then despite those figures, many engineers have neglected to review their PI policy limits over the years to reflect the increased risks that those figures would suggest that they face. In other words, we're seeing a growth in claims against engineers that are pleaded at sums in excess of the amount of insurance that they're carrying. And that leaves them in a position where liability caps in their appointment agreements are going to be increasingly relevant if they've got them. And for those that don't, then the threat of uninsured losses it becomes more real. So moving on to the next slide, and just thinking about what drives the value of claims. None of this is, all this is pretty basic stuff, but it just helps us to understand why we are where we are. Everybody will know that in principle, a claimant in any valid claim is entitled to be placed back into the position that they would have been in had the consultant not breached his obligations. So the direct cost of remedial work required to remedy any defect is always therefore going to be at the heart of any claimant's entitlement. But those direct costs are then enhanced by any manner of things. Principally, I tend to find that the additional costs of undertaking physical remedial works post-completion can be complicated by access issues. So think about remediating the foundations of a wind turbine that's halfway up a steep slope in a remote rural area, or think about having to access them if they're in the seabed in the case of offshore sites. Think then about indirect or consequential losses, the losses that flow from the defect as opposed to the direct cost of putting the thing right. So typically in the built environment, that comprises things like loss of rent for property owners because the building isn't safe or it's incomplete and so it can't be occupied, or operating losses because a business is unable to trade from defective premises. But it could also encompass things like delay costs, contractors paying liquidated damages and then recovering from his subbies, or just the additional cost of contractors having to spend more time on site while the problem is addressed. Major issue for us, it's always been there, but it's particularly relevant at the moment, is that of joint and several liability with other parties who are unable to pay their equitable proportion of any loss. It's particularly common in cases where a problem is partly the result of a design issue and it's partly the result of poor workmanship. So it leaves both the designer and the contractor jointly liable to the claimant for the full value of the loss, but the claimant will typically sue either both parties or just the one that is good for the money. So that is very often the well-insured designer with a substantial professional indemnity pot behind him, rather than the contractor who might have limited assets by way of cash or applicable insurances, and who might not even be trading any longer, which is something that we're all seeing in the press at the moment. And then legal costs are around a third of what insurers spend any year is on defence costs in the round, rather than on the cost of putting the problems right. So those costs are largely solicitors' fees, but they're also expert witnesses, barristers for those claims that develop that far in legal procedure, and that's typically sooner rather than later in Northern Ireland, also in Scotland, and also in the Republic of Ireland. But claimants' costs are always higher than our defence costs because they don't have the buying power that insurance companies have, and the insurance companies use that buying power to negotiate preferential hourly rates, whereas most claimants pay full whack. And then purely as a matter of process and chronology, claimants tend to incur costs in getting their claim off the ground before we've even appointed our legal team. So their costs are typically higher than ours. And when we lose, we can end up paying them. So in theory, they are entitled to recover their costs from unsuccessful defendants. In practice, they don't necessarily get 100% of those costs back, but it all is still enough to add substantially to what we end up paying where the engineer is liable. Now, that principle ought to work in our favour where we're successful in defending the claim, but more often than not, we find we recover little or nothing of our own costs outlay, either because the claimant isn't good for the money, or more commonly, we've just negotiated our way out on terms that have involved us having to provide some sort of a commercial or financial incentive to persuade that claimant to drop their claim. And that typically involves agreeing simply to walk away, bearing our own costs. So when you take all of those points together, the overall cost of claims will increase in an environment where the biggest projects are getting bigger and more ambitious all the time, and so it's more expensive to rectify them when they go wrong. Contractors are going out of business all the time for all manner of reasons beyond the scope of this talk. And then the principles around costs and the recoverability of costs tend not to work in our favour for the reasons that I've outlined. So moving on to the next slide, I'm not going to spend too long on this, but it's always useful just to remind ourselves of the things about an engineer's trading environment that I find are constantly reflected in claims world. We've already touched briefly on design and build, but again, a statistic I come back to again and again is the fact that 1 in 3 claims against structural engineers is brought by a contractor claimant, but the insurers of structural engineers spend 2/3 of their total outlay on the same claims. So there's that disproportionate relationship between frequency, it's a third by frequency, and severity. It's 2/3 by severity. And that should tell you something about the risks associated with design and build jobs. We also tend to find from year to year that most of our highest value catastrophe claims are on design and build projects. And again, we could go on at length about the reasons for that, but you'll all be familiar with much of that already. It all stems from this idea that contractors will very often accept huge risks in an environment where they win the work for submitting the lowest tender, and therefore accepting the greatest financial risks. And that renders a good many D&B projects inherently risky for that reason alone. Consultants are lower down the supply chain. That means that where things go wrong, you can end up paying the legal costs, not only of the immediate claimant against you, but the value of everything that sort of trickled down in the contractual chain before it reached his stage. We don't tend to be able to use betterment arguments in defending design and build claims, whereas we have them at our disposal in principle for claims under traditional procurement. And then contractors have a different relationship with the project than the owners do, needless to say. They have no long-term interest, and they have no other route for recovery, therefore, when they incur losses. If you compare that with employers who can look forward to rental income, trading profits, and they just have more options at their disposal when they find they're losing money. Another cultural theme is that of over-reliance by project owners, whether they are amateur one-off developers or whether they're major commercial outfits, on suppliers' insurances. And this attitude, it doesn't matter where risk resides, provided that it isn't with themselves. So Graeme touched on this earlier on, this culture of risk dumping. An engineer's PI policy isn't a first-party loss policy for the ultimate claimant in the contractual chain in the event of something going wrong. And yet, time and time again, we see appointment agreements appearing to apportion risk in such a way as to suggest that that's exactly what they are. So as much risk as possible is converted into contractual liability. And then, as Graeme's already mentioned, the consultant's inability to bring a 7 or 8 figure PI policy to the table at procurement stage is regarded typically as a deal breaker. And that seems to be almost the sum total of some employers' attitudes to risk. Don't manage the risk, just offload it down the chain. And then the third theme that I've just picked to talk about, this could be a very long list indeed, but it's a feature that comes up again and again, is that of litigation risk. It's the collective term, if you like, for the many things that can go wrong at trial, either for a claimant or a defendant party, and that's no matter how confident they might be about the merits of their position based on legal and technical expert advice. Parties preparing for trial normally consult barristers on their chances of winning. And I think there's a lot of significance in the fact that barristers would tend to describe a case with a 70% likelihood of success and therefore a 30% chance of failure as being strong or even very strong. So 70% is more or less as good as it gets. And I see very few barristers ever expressing a greater level of confidence than that. And the reason for that is that there are just so many variables in the equation that even senior counsel can never predict with any certainty what the outcome of a trial will be. Courts do produce some bizarre decisions, but it's not just down to mad octogenarian judges. Far from it. We're thinking more about things like expert witnesses changing their minds under cross-examination, or factual witnesses panicking in the witness box, having failures of memories, those very human elements that just make going to trial an inherently risky business. So moving on to the next slide, can we identify, I mean, Graeme sort of started to do his list and then admitted that actually a comprehensive list would go on for many slides, and it still wouldn't be complete. But from my perspective, from claims world, I've just picked on 3 things that I think are interesting to think about. High spec luxury accommodation is interesting. Arguably, it's more relevant to architects than engineers, but I think there are still some learning points in there, because overall, a quarter of what insurers spend on structural engineers' claims spend it relates to the residential sector in the round, and that might be partly a product of the amount of work that engineers are doing in that sector rather than in any other. It's always going to be a huge source of work, so yeah, it would be a significant proportion. But there is this recurring theme of one-off dream homes for wealthy clients who decide to try their hand at building one-off projects, either as an investment or as their retirement home for themselves. Often at the high end of the market, and these people are people who can afford to litigate when their sometimes unrealistically high expectations aren't met. We tend to find on the one hand that clients who have a purely commercial relationship with any project are arguably those who are more likely to pursue recovery by way of claims if the project doesn't deliver the investment return that they'd expected. But homeowners seem to be the exception to that rule because they have emotional attachments to their properties. And as I say, if their expectations aren't met, we tend to find that they expect fully to be compensated. Everyone will be familiar with the idea, with the inherent problems in value engineering and contractor proposed alternatives. So I won't go on about that, but it remains the case that this endless demand for uncompromised quality for severely limited budgets, especially on design and build projects, simply cannot be met, and people never seem to learn that. And then another major theme, obviously, is that about risk thriving at interfaces, whether it's the interfaces between various consultants' roles or between consultants and contractors. So we're thinking here particularly about consultants relying on information provided by other consultants. So typically, designers of foundations relying on ground information, which turns out not to be as comprehensive as it ought to be. And you're into then the themes about consultants' duties to caveat the advice that they're giving, consultants' duties to query or to stress test the information they've been presented with, and having the courage to say, I'm sorry, you haven't given me enough information for me to give proper advice in this area, and you're going to have to go and spend a little bit more money obtaining that information before I can do my job properly. And then I've already touched on joint liability for contractor failings, but that interface between where does the design end and where does the workmanship begin, and where do they overlap, is an overarching theme. And then with the next slide, it's really more of the same, and we touched on some of these already, including Grenfell, which is now over 3 years old, isn't it? June 2017. That sent a shockwave through the construction industry as owners of high-rise buildings in particular reacted to the event, and differences of opinion were then emerging about how to comply or how you should have complied with building regulations. So there are lots of claims out there at the moment, all resulting from that, directly or otherwise. And most of them are on ice pending the outcome of the public inquiry, because claimants are sitting there hoping that the outcome of the inquiry will then lend some weight of authority, even though they don't have the status of legal precedent, to their criticisms of consultants. It's not necessarily going very well for claimants at the moment, because the last couple of weeks in the news have seen cladding suppliers not come out of it altogether well. And that's good news for us, but that's just one small episode in an inquiry that's taking a long time to conclude. And until it does conclude, I suspect a lot of those fire safety claims that we've seen so far will just continue to move very slowly. And then new technologies, we've already touched a little bit on renewable energy and waste to energy. These aren't completely new, but risks do arise from either the pace at which technology and know-how develops, or because they're new ventures for the particular consultant who is involved in them. I tend to find that innovative design solutions are usually prepared with so much care and attention and pride by the engineers who come up with them, that they don't very often fail on a technical level, because they've been tested and checked almost to destruction. And if they do fail, then that failure stems from something else, like incorrect information provided by others. But more commonly, the novelty element might be partly responsible for costs overrun and delay. So the design in itself worked, but because it was the first of its kind, or because it was built on an unprecedented scale, for example, it proved impossible to estimate accurately for tender purposes, say the quantity of material required or the amount of time it would take to complete it. So that's more the angle that I would take on it. Waste to energy projects have had a bad press, partly owing to the sustained efforts of anti-incineration campaign groups who love to find examples of failed projects and trumpet them in the press. But the insurance market, despite that, can cite examples of high value claims that have come out of that have come out of that sector. And the same with wind farms. There haven't been very many of them, claims out of wind farms, but when they have arisen, they've tended to go very badly wrong, and they've cost the insurance market dear. And then I've touched on this theme already, but exposure to investor interests does seem to be one of those things that we come across a little bit more frequently than we previously did. I think consultants take on a lot more risk than they realise when a relatively innocuous and discreet service that they provide is then relied upon by an investor or a lender faced with an important decision. So we can think of examples of high value claims from feasibility studies or from project monitoring duties, which are completely disproportionate to what the consultant thought he'd taken on. So a feasibility scheme, for example, is then relied upon by the investors in the proposed scheme, and you stray into giving advice not just on the feasibility of putting the building up, but also its likely usage. So there's a famous reported case about the construction of a toll road where the feasibility study extended to estimating the likely traffic flow on the new road and therefore the revenue that it would generate. And you can imagine where that ended up. But it's not just about that. It also extends to independent fund monitoring on behalf of lender institutions, surveys that are relied upon by property insurers in deciding whether or not they're going to underwrite a certain risk. You might not command a very high fee for doing those things, and you take on an awful lot of risk in return. So it's one to think about. And then finally, just thinking about stuff going forward, it would be conspicuous by its absence if we didn't at least touch on COVID-19 and what, if anything, it had produced. And when we all first went into lockdown and we all ended up working remotely where possible, there was this worry that the inevitable disruption to construction projects would generate claims against the professional team, whether for good reasons or otherwise. Engineers don't typically have force majeure type provisions in their appointment agreements, and the law doesn't imply them into your contract just because neither party could foresee it, that a pandemic was around the corner. So in principle, you are exposed to them, but in reality, we haven't seen delay claims along those lines. I think professions have generally adapted very well to working from home where possible. The lurking worry that most of us have is that the quality of work being produced by perhaps junior engineers might suffer in circumstances where their line managers are supervising now very much at arm's length, and it's more difficult for them to spot errors and omissions. And communication is also more difficult, isn't it? Any personality who might be a bit introverted is far less likely to pick up the phone and query or clarify something than they would have been if they'd been able to just turn around and ask a colleague who's sitting immediately next to them. So that leads to people making assumptions instead about instructions or about the quality and completeness of information in front of them. And we know where assumptions lead, don't we? So if errors are creeping in as an indirect consequence of COVID, then there is that very real risk that they might lie undetected for some time. We haven't seen them yet. And then finally, everything you've heard from Graeme's talk will show you the reasons why, with insurers pulling out of the market left, right and centre, engineers and other professionals as well are forced to change provider from one year to the next. And that discontinuity of insurer from one year to the next then makes it far more likely that your current insurer will scrutinise whether the claim that you're notifying today properly belongs under today's policy. And if you had knowledge of that previously, then you probably ought to have notified it under a previous policy, but you can't now do that retrospectively. because of the claims made nature of the product. So subject then to certain safety valves, which some policies have, but others don't. And even when they have them, they operate subject to terms and conditions. There's a very real risk that you could find yourself uninsured for that claim. So do watch out, and please do make sure that you're giving the earliest possible warning to your insurers when you become aware of circumstances, even when the most spurious allegations are being made, whether expressly or by implication. And yes, Chetna, that is the last slide, I believe. So that probably takes us into Q&A.
Thank you very much, Stephen and Graeme. Very interesting. I found that very interesting indeed. We do have a few questions from participants. I'll sort of run down them as best I can. What alternatives to consultant PI are available for clients to take out where a consultant cannot procure adequate cover?
Very few, Paul, is probably the answer. It is possible there are project insurance solutions there, but that's a market that is suffering as well at the moment. And I think if we're talking about starting a project from scratch and involving a consultant that doesn't have PI cover from that point, then really that's going to be difficult. You're not just looking at it from an insurance perspective, but also from a liability perspective as well, because you would need to change the contractual position so that you're not relying on an adversarial form of contract where you're able to pass your liability on to the other party. So I think the options, unfortunately, are very few.
Okay, thank you. What are the implications of continuing to operate without PI cover? Most, if not all, professional institutions consider this a violation of their professional code of conduct.
I suppose where I'm seeing it particularly, Paul, at the moment, I would say, is in design build, where contractors particularly are failing to source PI cover. And I'm not sure that they would have the same requirements in relation to code of conduct. But what they are doing, I think, as a result of that, is where they're not able to access PI, they're then trying even harder to push their responsibilities down the line and to receive indemnities and the like from their consultants. So that's leaving the consultants more exposed as a result. I think where consultants have been unable to source PI cover, unfortunately, it's probably a question of having to close the doors. They would be, not just in breach of contract, but also in breach of, as you say, potential code of conduct or code of ethics with their professional body. I think where I would get a little bit more worried about consultants is maybe not necessarily just not being able to access cover at all, but significant restrictions being brought into the cover that they have. So a good example, I think, would be if you take an engineer, for example, who's working on a project, maybe what other members of the design team, such as the architect and the fire safety consultant, might find that they have wide-ranging restrictions in relation to fire safety. And if the engineer is the only one that's sitting there with cover, that creates greater exposure for them when the problems arise and somebody is looking at who's the target for the claim. So I think it's not just about whether all members of the design team have cover or not, but it's the quality of that cover and the restrictions that are contained within it.
Indeed.
There's also issues there, aren't there, around personal liability. If the firm no longer carries cover, then the individual who undertook the work could in principle be liable, or the individual partners if it's a partnership. There are slightly different and less serious implications if the business traded as a limited company, but it's all stuff to think about.
Thank you. What is the current market like for runoff cover, and what are the likely future trends?
Okay, so runoff cover, I suppose, just to explain to anyone on the call who may not have come across it, is the cover that you would put in place when you've ceased trading. So you still have residual liability from the projects that you've been involved in. So you need to maintain cover in respect of any future claims that might arise from your historic work. For a number of years, the market has operated runoff cover on an annual basis. So you need to renew that cover year on year. A number of years ago, you could have taken out a policy for 6 years or something like that, whereas now it is renewable annually. Where you'll tend to find problems, I wouldn't say that there is a runoff market as such. And I have to say, personally, I haven't experienced any particular problems in relation to arranging runoff cover. I think an exception to that might be, and it's important in the current market, where an insurer has withdrawn from the market. So if you have been with an insurer for quite some time, you're coming up to the point of your renewal, and actually you want to put runoff cover in place, and that insurer has gone, to try and attract a new insurer in at that point to simply pick up the runoff cover when they know there's not going to be an ongoing relationship over the years and the ongoing ability to earn premium. And actually all they're doing is picking up legacy risk. I think that's where people are going to run into particular issues, and probably are running into issues at the moment.
Indeed.
Another major worry for an insurer who's just looking after runoff risk is if the firm is no longer trading, but a claim is then brought against the legacy of the firm, it's difficult for an insurer to gather the evidence that he needs to defend the claim successfully. If you're relying on witness evidence from people who are just no longer around, or you can't find them, and the files are not, not being managed properly as they would be in the archive of an ongoing business, that's a major concern as well.
Any thoughts on collateral warranties?
I'll give you a few. I think it's a good example, actually, something that I touched on. It's an oblique example of something I touched on, which is it costs nothing to sign on the dotted line with a collateral warranty, and you might be tempted to, you might be lulled into thinking that this is something that doesn't require any work of you, which it doesn't. But then think about the risk that goes with it, because you're exposing yourself to claims from entities that would otherwise have no root whatsoever against you. So you extend yourself to the interests of funders, thinking about what I was saying earlier, with claimant parties whose interest in the project is purely financial and nothing else. Whereas absent those warranties, you wouldn't have any exposure to them at all. But at least with warranties, you get some measure of protection typically, because they tend to contain net contribution clauses where appointments are less likely to have those in. And you tend to have things like equivalent rights of defence clauses, and there's a whole host of safety valves there, which certificates, for example, which people sign and hand out to third parties, assuming that those certificates will operate subject to the terms of their appointment agreement, are very much broader in the type of claims that they can bring, and they don't have any safety valves at all.
Maybe just add into that, Stephen, as well, the equivalent rights is a good point, because with policy wordings getting tighter, what you'll tend to see in the vast majority of PI policies is that they won't cover liabilities under a warranty which are greater or longer lasting than the requirements under the appointment. So from that point of view, the equivalent rights of defence clause becomes even more important. And just I can't emphasize enough, actually, the position in relation to certificates. That's something we've seen really over the last 12 or 18 months. A lot of people being approached late on in the contract, or maybe even after the contract is finished, to provide something that was never part of their original appointment. Some sort of assurance, certificate, a letter of reliance, etc. They are hugely dangerous, and a lot of the time won't necessarily be covered by PI cover. So if there's anything like that, pick up the phone and we'll talk through it.
That's right. They're very widely worded, opinions on compliance and so forth, and yeah, they really do open up the doors. So be careful.
Okay, and one final question then. Participant is asking, is there a rule of thumb between project value and the level of PI that a consultant should be providing?
No. I suppose I get a little bit frustrated when people start linking contract value to level of PI. And I think sometimes when we talk to procurement bodies, the attitude they take is, well, the project is, this contract value, and therefore the PI should be X amount. For me, it should always be about risk reward balance for the consultant. Actually, what fees is the consultant earning? And based on those fees, what is it reasonable to expect them to take on as a limit on liability and a PI requirement? I think if you were to look at construction value and use that as a guide, it's very difficult, isn't it? That every project will throw up different risks and different issues. But I really feel there's a need to get back to looking at what the measure should be, and I think the measure should be a risk reward balance for the consultant.
I think there's bound to be a lot of participants on the call, Graeme, that totally agree with you. winning the battle with clients is the difficult bit.
That's true.
Anyhow, I think we're out of time. Many thanks everyone for listening in, and I hope you all found it as interesting as I did. On the screen at the moment and on the ACE website, there are upcoming webinars which might be of interest to you. Can I finally say very many thanks to Graeme and Stephen for taking off their time to present this to us, and wish you all the best and see you soon. Thank you very much.
Thank you, Paul.
Thank you.